Let's get across the market open. Kyle Ryder joining us from capital.com. Kyle, welcome as you join us from London. Let's take a look at where we finished on Friday, particularly with a focus on Wall Street. Certainly, any buoyancy from the US government shutdown has faded quickly, hasn't it?
Yeah, it was a 2 or 3 day sort of flash in the pan, really, and it makes sense. We did see on the Friday before the kind of impact to the markets that some of that consumer sentiment data had about the deterioration effectively in confidence in households because of the shutdown had on market pricing. And then obviously subsequent to that, the hint that there would be an end to the shutdown really kind of setting off that relief rally. It was somewhat of a buy the rumor, sell the fact kind of story, because by the time Thursday rolled around, we'd really lost the momentum behind that move. And we're back pretty much focusing again on the path forward for US interest rates, as well as this, what I would call a AI ROI trade, concern about return on investments for some of these, Magnificent Seven stocks. So we did see a lot of whipsawing price action on Friday night. We did finish off the day's lows, but if you look at even just some of the movement in cryptos over the weekend, it just sort of speaks of a little bit of risk aversion ahead of a week that could be, pretty high on event risk, actually.
And we've also had even more hawkish Fed speak as well, obviously playing down any chance of a rate cut at early next month.
Yeah, and it's been a pretty consistent message across Fed officials. You do have a few doves there. Mary Daly's, normally the most famous one, emphasizing the need for policy support to protect the labor market. But since we saw that language at the last Fed decision from Jay Powell, which was that, a December cut shouldn't be considered a foregone conclusion, there's essentially been, again, this concerted effort from the Fed to try and water down the expectations of rate cuts a rate cut in December, certainly the kind of rate cuts being priced into the markets going forward prior to that last meeting. And what the Fed's trying to achieve is not necessarily lead the markets from pricing in a cut at all, or even suggest to the markets that it's not going to cut in December. But what it's trying to do is really maximize that optionality it has, because if you look, say, 3 weeks ago, we had the markets pricing in pretty much a 100% chance of a December cut. That despite a lack of economic data, the data that we were having suggesting, of course, on one side of things, a deterioration in the labour market, but on the other side too, a persistence in inflationary pressures. And again, what the Fed is trying to do here, and the officials have tried to achieve last week, and it has to be said quite successfully, is rebalance the risks in the market to reflect that a cut is not a foregone conclusion. So as of the end of Friday's trade, we saw actually the implied probabilities of a hold at the December decision move ahead of a cut by a ratio of, say, 55% to 45%. And it really does kind of suggest now that until we either get clear data that shows a signal for the Fed about what direction it can go, or we actually reach the meeting in December, there's likely to be uncertainty in the markets, and therefore obviously volatility will follow that.
And you mentioned that AI return on investment trade there. Obviously, that's going to be very much in focus this week with Nvidia.
Yeah, it'll be the biggest corporate event, obviously, probably the biggest earnings result that we'll get for this US earnings season. And, maybe just for this week, it could be even the biggest macro event too, because there's so much informational value in the results that we get from Nvidia in terms of, demand for chips from hyperscalers, and just broadly speaking, the infrastructure and growth being seen in artificial intelligence. The expectations are, of course, as it has been for a really long time, strong growth, but moderating growth, revenues that will continue to be, largely strong. Questions about the scaling up of, Blackwell chips, as well as some of the more advanced chips that the company is trying to roll out and deliver. Fears about the impact on the company from geopolitical risks, especially between the US and China, and whether that will impact market share sales in the Chinese region. But ultimately, at a very high level, the market's going to be looking at these results to see if there is sort of any evidence that this kind of artificial intelligence trade is going to slow down. You can trust Jensen Huang to talk up the prospects of the industry going forward, and of course, he's got very significant skin in the game. But, we have seen the stock come off quite a bit over the last few weeks. Arguably, that suggests that, there may be a little bit of a room to bounce if we get an upside surprise, that we're not in a position like previous quarters that the bar is set extraordinarily high for the company to exceed, because we're no longer at that sort of $210, $215 per share mark, much closer to sort of 170, 180. But nevertheless, it's going to be the big market moving event for the week, and it will sort of give a very, well, powerful signal on, again, this AI ROI trade, and whether, all that hope being built into asset prices up until recently, may have been a little bit misplaced.
And Kyle, meanwhile, what's going on in the UK? A lot of disquiet about the upcoming budget.
Yeah, there was a little bit of volatility on Friday, more or less, when it was suggested that Chancellor Reeves might scrap income tax hikes, more or less because it was revealed later, or at least suggested later by Downing Street, that the fiscal position had improved much better because of a higher tax intake and stronger growth than previously thought. But there is huge political ructions, obviously, in the UK, the Labour Party falling significantly out of favour, Keir Starmer being incredibly unpopular and by some metrics boasting the lowest approval rate of any Prime Minister in recent history, a huge populist backlash over here because of waning living standards and a sort of general frustration around issues, economic, immigration and social. And it's combining this kind of perfect storm for the UK economy, where there's fears about the economy at a very fundamental level, a fear about fiscal settings and their sustainability, and we did see at stages on Friday as well that kind of very ominous sell-off in both bonds or each of the bond markets, so gilts, the pound and stocks as well, and the FTSE pulled back pretty significantly from record highs. So it could be a pretty volatile period in this part of the world. One to watch out for, whether it be because of a leadership spill or what have you, or at least because of the budget, because really it's one of those situations that the UK is in right now, that there's only bad options before the government, before the country, and it's really a matter of which bad option they pick to try and hopefully yield a good outcome or a better outcome much further down the line.
And Kyle, fairly quiet week ahead locally. What do you think investors are likely to be watching out for?
I think it's going to be a lot of cues from overseas markets, obviously, and we do have, it has to be said, what could be a bit of a deluge of data coming out of the States because of the end of the lockdown. And, we don't really know when all of that's going to be released yet. The public servants are only really summoned back to work or to be back to work over the coming days. But it's going to provide a really clear picture about the US economic growth outlook, and as we said off the top as well, the outlook for US monetary policy. One thing that could salvage market sentiment here is if we do start to see the prospect of rate cuts increasing in the States, because that might see a little bit of a rotation trade, which was underway a little bit last week, back in towards cyclicals, and some of those passive flows and improvement in sentiment might help offset some of the sluggish company fundamentals that we have on the ASX 200 at the moment, as well as those fears or perhaps even disappointment that the RBA is not going to be in the position in the foreseeable future, or at least in the immediate future, I should say, to cut interest rates. So I think that could be the critical mover, global factors, and in particular US data and what it says about where the Fed is at, and therefore the US economic cycle.